Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report Weekend Show, the first weekend show of 2025. A great time for us to look back on 2024 and even more importantly, look ahead to this year. Some of the key themes carried over from last year and what could change for all of you traders and longer term investors. Corey Fleck here hosting this first weekend show of the new year. As I said, we're going to be talking more big picture with a couple of my favorite generalist commentators and active traders in the market. Be sure to check out our website, kereport.com, and podcast. Just search The KE Report in your podcast player to listen to all our daily editorials and the extended versions of the weekend show. To kick off this show, I am chatting with Rick Bensignor, president of Bensignor Investment Strategies. Rick writes the institutional newsletter called Supposedly Irrelevant Factors. That is read by some of the most successful hedge funds in the world. And on the retail and individual side, check out the In the Know Trader website. I will post that in the show notes. Rick has three products, the first being 7-Eleven Ultra. This is now Rick constructing a portfolio like a hedge fund would build. So instead of paying hedge fund fees, you get to manage that through Rick's 7-Eleven Ultra. He also writes the weekly report called the Tactical Trader Report and a daily report called the Daily Tip Sheet. Rick, let's start off with a quick recap of 2024. What were some of the key themes as a trader and investor in these markets that really stood out to you last year?
Well, I think, Corey, the overriding theme for most of us, and most of us are in the stock side, doesn't mean we don't look at other things or aren't in other sides of different asset classes, but as we're generally all kind of stock junkies at some level or another, the biggest overall theme for sure was the dominance of the Mag 7 and the type returns those mega cap names had relative to the rest of the market, as well as the fact that collectively they're probably somewhere around between 30 and 35% of the entire S&P in 7 names. So you've got to either own them or play them correctly to have any chance of matching the benchmark return, unless, of course, you're just invested in spiders, in which case you have them in spades anyway. But if you tend to be more of an individual stock type person and don't have a lot of exposure to the broad indexes themselves, then the only way you could have had a really good year is to have had good, significant exposure to those names, or at least enough of them to have participated and gotten the type return the S&P's had in 2024.
Rick, when we look at these Mag 7 stocks, some people have said that these have been a defensive play, where investors, if they don't know what to do with their money, just put it in these big boys because they have cash, they have this stability. Do you see Mag 7 as a defensive rotation play for when people get a little worried or nervous about future market moves?
I don't really look at them as defensive per se. I look at them as the strong the momentum names. And pullbacks have been minimal, and therefore it's been the type place that, because they are such strong companies and they have the balance sheets to invest in the future and to put tremendous money into AI, which more and more we're learning is capital intensive and may or may not pay off for years to come. You know, it's a fairly, I don't want to say defensive place, but it's a place that so far has not seen material drawdowns. And therefore, it's been a place that still gets funds, kind of regardless of what the market's doing. But look, up until, a few days ago, the market's been pretty much sitting on all-time highs. So you've had minimal type negative impact to your portfolio if you're long those names. So they're both momentum. They're where the growth is coming from. They're the elite of the growth names. There are ETFs that let you, invest in them. And more, we're starting to see more ETFs coming out that are top 50 names, top 25 names. There's already MAGS, the MAG 7. So literally you can just buy that ETF and you've got exposure to all 7 names in their proper proportion. That's been where the public is investing and looking for the future growth to come from. And look, at some point, you come up with these little tiny names that people haven't paid attention to that all of a sudden become stars. Take a look at a company like Palantir, which I've personally owned for a while. I always kind of believed in the story, and I had to be very patient with the name because when I first got in, I think I paid about $28 a share, and I added more at 18 a share, and maybe even a little more, I think at 15 or 16. But until 3-4 months ago, I'm just sitting there, twiddling my thumbs. But finally, it's caught on fire, and now it's 3 times plus what I paid for it. So it's paid off, and so these names come out of kind of very sleepy long-term bottoms that eventually the market wakes up to if they're in the right place and they're doing the right thing. Now, personally, I think what Alex Karp, the CEO of Palantir, has done and built and continues to believe in what is protecting America is something that ultimately people paid attention to, woke up to, and now we're seeing the benefits of that. And I'm not on the fundamental side enough to know what its proper valuation is, but I will tell you that to me, it's the type name that if you have this, I don't know, where's it, $75, something like that, wherever it is, if it ever pulls back to 40 or 50, you just want to be all over that, I think. And, for the longer term, this is a name that finally has turned the corner, really has interest in, and, I think it's a future star.
Interesting. Well, that's really taken off to end this year. One other theme that I just want to quickly get your opinion on, more at the end of the year, Q4, let's call it, we saw widening out of breadth, a number of sectors playing a bit more catch-up to those MAG 7 names and a bit of rotation into the lagging sectors. Is that sustainable? How do you take that whole rotation trade and the potential of underperforming sectors playing catch-up?
Well, I think it's going to depend, like it often does, on a few things. One is, yes, we saw a broadening out. At the same time, it's not as if MAG 7 type exposure really came off. So you just got more participation into a broader sense of the market. And generally, that's good and healthy and what you want to see for a sustained market run. As far as the sectors, they continually, well, I don't want to say all 11 major economic sectors that make up the S&P, which, they just frequently kind of rotate into being in favor and out of favor. Right now, like what's most out of favor? Healthcare. It's a dog. It had one good year. I think it was 2022 when the market was down. Healthcare was terrific. And it's been terrible since. So you're talking 2 years of just kind of disaster compared to the rest of the market. Energy was the best improved player over the last few months, but it's now stalling. And XOP and OIH, the two kind of major energy equity related sectors, subdivisions of, let's say, XLE, which is just the broad energy index, had very solid gains and gave them all back. And I was very surprised to even have seen the gains. With oil sitting between the bulk of the time, the mid 60s to low 70s, it was kind of hard to see why the gains were there that had shown up in the last few months. But in the last few weeks, it's given it all back. In one of my products that I have, the daily tip sheet through In the Know Trader for individual investors, we went short Chevron a few weeks ago, but I'm pretty sure it was early December at about 160, and we still have a quarter of it left. And last I looked, we're down in the low 140s. That to me made sense. I didn't understand why it had moved up as much as it has. So there's a lot of sector rotation and things that happen where sectors come in and out of favor. And recently, financials were on fire, but then over the last few weeks, they gave so much back. Kind of the breakout, if you look at XLF divided by spiders and you look at a chart of that, it finally surged forward, I think it was in November, and then gave a whole bunch back very quickly in December. The game of sector rotation and kind of being in what's hot and trying to avoid what's not is what I did for the last 4 years with the 7-Eleven report, where it was simply just being or trying to be in the right sectors at the right time using those 11 spider sectors. And, I did that very successfully. I stopped after 4 years. I stopped that report and turned it into 7-Eleven Ultra, which is this hedge fund report that I now do, which gives investors the chance to be in essentially a professionally run hedge fund, but instead of paying 2 and 20 in the fees that they're accustomed to, then all you have to do is follow what I suggest you do. And so far, we've done very well with that, barring one blow up in one name that we can talk about. One trade gone real sour. Otherwise, we're doing pretty well.
So, Rick, let's look back on to some of the best trades, some of the biggest winners, and maybe that bad trade that you had, what we can learn from all of it. Take us through what some of the good and bad were from last year in terms of your trading.
Okay, so let's start with probably one of the worst trades I had this year. Was a 4% allocation to a long-short pair trade in the 7-Eleven Ultra report. It was long Target and short TJ Maxx. And I don't know if it was mid-November, somewhere around there, I feel like both reported their earnings and Target got mushed. The stock fell 20% in a single day. And we got out within, I think, 48 hours of that report, maybe even 24. So TJ Maxx was kind of flat after they reported. And if I remember correctly, Target was the same day and absolutely missed. And, they took the stock apart for a 20% hit in a single day. So we lost about 20% on the pair trade. But the pair trade was a 4% allocation to the total portfolio. So sure, we lost money, but it's in the context, and here's kind of what you learn. So even in the face of a blow up, I tore apart management for so misleading the public the quarter before with positive commentary about the stock and and then one quarter later they absolutely missed terribly. In my view, the entire management, the whole C-suite should be replaced at Target. I'm a professional trader too. So the idea didn't work. Doesn't matter to me why and what the reasons are. And obviously there are real problems at Target, but you take your loss, you go away, you lick your wounds, but you let that last for 24 hours at max and you move on because there's always opportunity elsewhere. And you've got to have your mind clear and focused in order to find the next opportunity and stop worrying about what's already happened. You can't change what happened, it's done. And I'm not the type to typically stick around with bad trades. A trade is a trade. And whatever thesis I had for why Target should outperform TJ Maxx over time got proven wrong. So you take your loss and you move on. So one of the things you learn, and hopefully in what I've just said, people learn that sticking around with things that don't work are likely to be very costly over time. And if you had a thesis for why you're doing something and the thesis gets disproven, and price can often be the real decision of if you were right or wrong or that you were proved correct or incorrect. But when it proves you wrong, the best traders in the world are going to tell you, you take your loss and you move on. And that's that. I think back to comments by people like Soros, Druckenmiller, who learned at Soros and then became his own fantastic money manager and family office guy. You observe what's going on, but when your thesis gets proven wrong, you get out. And that's that. And it's that simple. And then I'm not saying it's so simple to do, but in reality, it's just emotional baggage that you tie to something that didn't work. And the best traders in the world simply move on. Back in the days, I used to teach trading classes at New York University. I remember quoting Soros as saying his track record was that he typically lost on 2 out of every 3 trades. Now, if you think about that, how did this guy, who became a legendary money manager and hugely successful, and I'll put aside current politics and the fact that I'm no fan whatsoever of the man in current days, but let's just look at his Wall Street career and judge this conversation based upon that. If you lose 2 out of 3 times, and you're one of the most successful money managers who ever lived, there's some information there that you have to understand and see. One is the man knows how to manage risk. Number 2, he doesn't stick around for things that don't work. And one of the biggest things he ever taught Stanley Druckenmiller was, if you do your research and you have an idea, bet big. Because if it's right, you make a killing. And if it's wrong, but you don't stick around when you get proven wrong, you come back to fight another day. And that is something I taught people. That the last class of every semester was psychology of trading. And that was one of the key things I always talked about, was managing risk, not sticking with losers, and understanding that your responsibility, whether you work at a company or you trade for yourself, your responsibility is long-term survivability. And you can't possibly stick around if you bet the whole house on a single idea. So when I say bet big, I'm not talking about betting the house on one idea. But if you have concentrated bets and you've done your work, and some are not going to work, but more work than don't work, and you control the downside when they don't work, and the ones that do work pay off big, you've got the winning formula for success over time.
Yeah, such a good point. Cut those losses and really understand, if a trade doesn't work out, you don't need to stick around. That's the beauty of trading and investing. Let's look into 2025 then. Some key themes and topics. Look, I'm sure it's going to be dominated again by central banks, by AI, also geopolitical conflicts that were all around in the last couple of years. What are some of the key themes that you see carrying over? Any new themes emerging?
Yeah, I'll tell you what is one of the big things that worries me. And I was just interviewed a couple of days ago on a Substack podcast by a guy named Rich Excel, Excell. He writes a column there called Stay Vigilant. Rich is one of the smartest guys I've known in my entire 40-year career on Wall Street. We met about 25 years ago, and he was a derivatives trader back then at the UBS O'Connor. And O'Connor was like the derivative side of UBS. And I learned a ton from him and realized how much smarter someone who thoroughly understands, and this is back then, now I'm pretty good at myself, but somebody who thoroughly understood the ins and outs of options trading. You know, back then, if I was bullish something and I wanted to express it through the options market, I'd buy a cheap out of the money call. And 8 out of 10 times I'd lose money. I go, I don't get it. I'm right. I'm bullish. The market moved up, but I lost money. And while I knew nothing, obviously, I knew nothing about options. And these guys could have on dozens and dozens of positions and actually not care at all which way the market went. And to have a brain that could manage that many positions in real time and then say, doesn't matter if the market goes up or down, I'm hedged and I'm good, but I can still make money. Like I couldn't figure that out. Anyway, Rich and I talked recently. We haven't seen each other since 2010. He lives in the Chicago suburbs, but he interviewed me. And it's something I would suggest all your listeners listen to, because the analogy I gave my own clients when I sent the link to the piece out was Rich and I talking for an hour about markets is kind of akin to Mantle and Ford talking Yankee baseball, years after they retired. I mean, we're still both in the game, but we're two guys who grew up in the business in the 80s. And now it's, 40 plus years later. And not just the stories, but the things we've learned and the way we approach the game is so different than most people now. It's really, believe it or not, I think the 80s and 90s were probably the best time ever on Wall Street. And what I see now, the people on TV, I mean, it's just such a lesser degree of, I think, market smarts and market intelligence. The analysts, the strategists, the people interviewed now, they, in my view, and only my view, I just think it is such a kind of diminished type of community of people. And so much of it is they are so focused short term, and there's so much more to the game of playing the market than what they talk about. They sound like robots who have recently graduated college, and they're speaking out of a textbook as if the right way to play is what a textbook teaches you. So Rich interviewed me for an hour, and the biggest concern I see going forward is that rates are probably heading higher over time. I've made it clear for the last couple of years that the 40-year bull market in bonds from 1980 till 2020 is over, that there'll be a long-term return, or I'll shift in this sentence where I use the word long-term. There'll be a return to longer-term equilibrium pricing of, let's say, the US 10-year, and that probably puts it more in the 7 to 9% category, than the current 4.5%. And what's the possible biggest problem going forward is that the US government has to replace debt that matures that they were paying, 2% or less on just a few years back, that now they're going to have to pay substantially higher to borrow. And I think sooner or later, the stock market is going to have to be more permanently affected by the fact that the US government needs to finance itself at much higher rates. And that is going to have a bigger effect on everything, including taxes and the whole trickle down of the economy, inflation, et cetera, because of higher rates. And as someone who just a few weeks ago turned 66 years old, so I'm kind of in that age where, it doesn't mean I'm going to retire. In fact, it's not anything remotely on my mind. But when you think about that, the average person, as they get into their mid-60s, starts thinking about shifting and making sure they have, the traditional 60-40 split between stocks and bonds ends up going to 50-50 or even 40-60, and you more heavily lean towards bonds. That's not going to work if yields are going to still move materially higher. And that's a real cause of concern going forward, because as you have an aging population and baby boomers are getting closer and closer towards that kind of retirement type scenario. And again, it doesn't matter if necessarily if they retire or not, but the population group that's getting into their mid-60s and will be over coming years and starts thinking about, okay, I need to be more in bonds. Well, you're going to shift into a market that's going to lose you capital. So you might get a higher rate of return, but you're going to lose capital on those bond purchases unless you actually hold them till maturity. And so that means bond funds, if you buy TLT or any of these bond proxies, are going to lose money just as you're looking for the safety of where you should be moving towards as you're getting older and away from the risk of the stock market. So that's a big concern, because I think here, if we shift now towards themes for 2025, I think there'll be one more push higher. After still, I think we're going to see a decline now, and I think we see further downside. There'll be probably in 2025 one new push higher above where all-time highs are now, and maybe we'll move another 5% higher, give or take, something like that. And then I think this thing comes to a screeching halt for several years. And you're not going to see the type returns that you've seen in the past, the theoretical 8 to 9% return. I think we go through a period where you don't come close to matching that. And although historically there are very few years that actually get you the average return of 8 or 9%, most years are up more than that, or not up as much, and occasionally you have some down years. So there's very few years that actually are the 8% or 9% gain. But I think that the best years have probably been seen in this cycle, and I'll say the cycle started, let's call it March of 2009, the end of the great financial crisis. I think stocks are going to have troubles, and not immediately, but if rates move up and we get 7%, 8%, the US 10-year or even more, I think it's going to materially affect the stock market in a way that is not positive. Let's put it that way.
That is very interesting, Rick. It does make sense if we do see the bond market continue to sell off, rates move higher, since we touched on then stocks and bonds with the broad averages. How does that correlate to currencies and even commodities? Is the US dollar going to do well because rates are moving higher? And what does that mean for commodities?
All right, so let's start with the dollar. The dollar a couple days ago made a new high as things surged. So the dollar index got to 108.5 or so, made a new high above the November high. And it's on the crux of, it depends on what happens, let's say, over the next month or so. But if this breakout or the start of breakout is real, and the longer we stay, probably, I would say something, let's see, trying to remember, I think the high close this year had been 107.5. So the longer we would stay, let's say, above 107, give or take, and push higher, then I think the dollar could easily get to 112 and possibly even take out the 2022 high, which was, 114.75, if I remember, something like that. It's possible the dollar goes all the way up to 125. Now, I'm not saying it's getting there yet because we don't have enough proof that it's actually breaking out. I don't judge a day or even a week necessarily, but over coming months, if we continue to stay above 107 and you kind of build a base there, then 112 and change to 114 and change is next, and very possibly 125. And there are huge implications for trade, certainly for commodities, if the dollar gets that strong. And, for things to think about in the, scheme of things. And as high as that sounds, it's not the all-time high. All-time high in the dollar was 1985. The dollar index got to 165. So there's still a huge amount of room to potentially go for a dollar. And so here, let's think about what's happened in the last 10 years and what can we use as some type of reference. Well, when Donald Trump won the 2015 election, November of 2015, the dollar surged into December 31st that year. But then in the very first week of January 2016, a couple of weeks before he was actually put into office, and it might have been the first or second day of the year, trading day of the year. So not only was it the first week, but I think the first day or two, the dollar peaked and sold off almost the entire year. So it was one of these kind of buy the rumor, sell the fact type things. And we're seeing it now. The dollar, since Trump won the election in November, the dollar's been up. It's made a new high. And then we have to kind of see what happens. And is this going to be similar to 2016, where it peaks to start the year? Or is maybe Donald Trump 2.0 going to be looked at differently? And as he's clearly US focused, is his type of politics and thinking about the trade agreements and things that are in place or need to be changed in his mind, isn't going to make the dollar even stronger and stronger at the cost of other countries. That's yet to be determined. But if that takes place and the dollar regains, I mean, look, it's been de facto currency in the world for international trade, and many countries are trying to stop that over time from being the case. But if the dollar reemerges and flies to the upside, that's going to have huge implications for not only US multinationals, but for relationships between countries, US-China relations. There's a lot of politics and things here that are potentially at play, and the dollar is going to reflect how that is likely to pan out. And that leads to metals and commodities. Obviously, if the dollar surges, the metals will not be. And as you know from prior conversations that we've had on air, I sold out of half my long gold at $2,700 a couple months ago. And I got to 2,800 and then it fell under 2,600. So it's not like this has been a fantastic call, because it's a little lower than I sold it, but nothing appreciable. But if the dollar is starting to surge and interest rates go higher and it drags the dollar higher, then metals are in trouble. And if you want to look at gold, gold could go all the way back down to, I don't know, 2,450 to 2,350. I'd be happy to replace the gold that I sold at the 2,700 down there. That to me would have been, that'll be a very good trade for now. It's just too early to tell. But metals will be in trouble. And then you got to look at oil. And oil sitting, it's been sitting at $70, give or take. And I can make a better case for oil to go to $50 than I can for oil to go to $90. All the Mideast tensions and all the political crap that's happened, let's say in 2025, if that couldn't get oil to $90, could barely get it much above 80 and stay there. There's a shelf right now at about, I think it's $66. If that cracks, oil could easily go to 50 or lower. And if that happens, then you will have a big relief on inflation. And it'll help the consumer in a lot of ways as far as spending and having more cash. Certainly not good for the energy companies and investments there. And of course, for anyone who's kind of a history student of the market, you go back to when these spider sector ETFs started, which I think was 1999, maybe. Energy has been the single worst sector to be invested in over the past 25 years. Up until recently, I think it was, you were actually even underwater being in XLE relative to the S&P. I mean, it was the only sector that you did not make any money in 24 years. So investing in energy generally over a couple of decades now has not been the right thing to do. And despite oil going from, let's call it single-digit dollars to $133 at the height of, or at the beginning of the Ukraine-Russia war, investing in energy companies has not paid off. It's the only sector that has not paid off doing so. I mean, think about being invested in something for over 20 years and having zero return. That's what you had with XLE. So a lot of stuff to think about this coming year, and a lot of macro tailwinds and potential headwinds for investors to reckon with. But if I had to look at anything, the most important thing, I think you got to pay attention to what the U.S. 10-year is going to do.
Okay. Hey, Rick, that is a lot to take in. Yeah, 10-year and even the dollar, too, because of how much those carry over to some of these other sectors. Undoubtedly, it's going to be an interesting year, and it's going to kick off real early on the political front when Trump takes office. And internationally, boy, oh boy, it never seems to slow on that front. But hey, Rick, thank you very much for kicking off this new year with us. Again, remember, everyone, click that link in the show notes. Visit the In the Know Trader website. Find out more about Rick's retail and individual trader products. And Rick, I'll chat with you again next month. Absolute pleasure having you on the show.
Happy and healthy New Year.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the New Year's edition of the KE Report Weekend Show. I am now chatting with Mike Larson, editor-in-chief at MoneyShow. I'll post a link to the MoneyShow website so you can find out all of the upcoming conferences. Now, Mike, as I did in the first half of the show, I'm going to be more or less looking ahead to 2025 this year, some of the big picture themes. Now, it's always hard to predict what's going to happen in the year, but quite frankly, we have some big picture themes to discuss that will cause some market volatility and I think really define the trends that we see this year. Before we do that, though, let's quickly recap 2024. I was asking you before recording here some of the biggest winners, some of the biggest disappointments or losers in 2024. You had a very good answer of just how strong these markets were. So, Mike, when I asked you that question, what do you have to say about balancing out what some of the best winners were and some of the disappointments?
Yeah, I mean, I think when you look at the sum total of 2024, it was a pretty strong year all the way around, right? I mean, global stocks underperformed U.S. So I guess if you had to say what might be disappointing, it was kind of, the global names not really doing all that great. But in general, whether you're talking about the broad averages, stock averages, whether you're talking about sectors, most sectors participating, especially in the back half of the year, whether you're talking about gold, silver, and metals, with the exception of kind of these December stumbles that we saw in some places, overall is a strong year. And obviously crypto was an extremely strong year for that part of the market. So, I think it was an environment where with Fed policy changing, with recession fears fading, and especially in the back half of the year with broadening out in the markets, less, kind of all tech all the time and more, hey, let's throw some financials, let's throw some materials, let's throw some other small caps and things like that in there. It turned out to be a pretty good year for investors. And, we've hit on the theme of being bold. My Be Bold thesis has been in place for 2 years now, going all the way back to the start of 23. And I think that what we've seen since then, 2 years basically of 20% plus returns in the S&P and some strong returns in other parts of the market, including obviously precious metals, I think that it kind of panned out, I think. So again, the only disappointment, I guess, would kind of be the cold water Jay Powell sort of threw on the market at the very end of the year by talking about fewer cuts in 25 and the lingering inflation and issues with tariffs that might cause inflation in 2025. But other than that, I mean, it really was a pretty strong year. It was a pretty broad advance. You could make money in a lot of different places. It wasn't really a struggle with very little participation. And even some parts of the market that had been lagging, things that were beaten up and the narrative was that it's going to stink forever, like commercial real estate, kind of picked up towards the end of the year and showed a little momentum too. So I think given that being the case, not great, but recovering from some of the depths that we had earlier in the year, all that speaks to a market that just has, a pretty good backdrop as we enter this new year. I don't think it's going to be a runaway kind of year that we're facing, but I do think we're probably in for some decent gains as well in 25.
Okay, let's talk about the big picture themes then. You brought up central banks and the Fed. Let's start with central banks because, look, the Fed, they aggressively cut rates at the tail end of the year, even when people were saying, stop cutting rates. I find it funny because before they started cutting rates, everyone was saying, the Fed's behind the eight ball. They need to start cutting. And then they started, and then everyone said, they're cutting too much. They need to pause. That's always what you get with kind of the armchair quarterbacks. But look, the Fed outlines only two more cuts for 2025. Other central banks around the world are talking about maybe slowing some of their cuts, but they've been more aggressive than the Fed. How are central bank policies going to guide 2025?
Yeah, I mean, it's clear again, especially as we got to the end of the year, that expectations were being dialed back for what kind of largesse you could expect from Powell and co. in 25. I'm not all that surprised. I mean, some of the inflation data, it's gotten a heck of a lot better from what we had in the middle of 2022. I mean, you go back to the CPI there, I think the actual peak there for CPI was like 6.6%. Core CPI got back down to the low threes, more recently high twos. That's a big improvement, in the markets, I think, traded the way they did because that improvement was happening. Now, that being said, does it mean that, we're where I think the Fed wants us to be? No, not really. Is it as great as things could be? No, it's not. I mean, I think they would much rather see a number around two. And I think that's why the Fed is signaling sort of this, yeah, we're probably going to cut, but don't expect it at every meeting and don't expect a lot of it either. That is a change. And that's why I think you saw some of that very late year volatility. Santa Claus rally kind of got derailed a little bit there. And again, that's probably the only disappointment I see. But that being said, I think when you look at the outlook for 25, the markets will be able to cope with a Fed that's only cutting a couple of times because the Fed's not hiking, number one. I think also number two, things like the dollar rally that was prompted by the Trump election and all the expectation that it's going to lead to extremely strong growth in the U.S. relative to the rest of the world stinking, and therefore just buy dollars hand over fist. I think that move is probably overdone. I think the interest rate reaction that we saw is probably overdone. So I'm a little more sanguine about these big picture risks. I don't think dollar surge, treasury yield surge, blah, 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 all that stuff is really going to be a big factor in the year. I think we're going to kind of settle down. We'll have some volatility, and we're certainly not, in my opinion, looking for 20% plus returns in the S&P again. But do I think we're running this thing off the rails? No. Do I think the dollar is just going to keep soaring and rates are going to keep soaring, forever and ever? Amen. No, I don't. And I think that is an environment that you can still be constructive. I think my personal opinion is a lot of the things that didn't participate as much, that were sort of laggards to tech, but that started to participate in the back half of 24 are probably going to be where you want to be this year. It's the things like financials, it's the things like materials, it's things like transports, small caps, some of this stuff that had just sort of been left for dead when everybody wanted tech and only tech. I think that's where you're probably going to see some improvement. A few reasons for that. I mean, again, a U.S. economy that's going to avoid recession and that domestically may have some benefits from some of the administration's policies on a tax and regulatory front. That probably helps. Some of these smaller companies that are more economically levered. Credit issues. I mean, credit concerns have been fading. All the hysteria over commercial real estate defaults and delinquencies and all that stuff. I mean, that was kind of the story of 23. It started to turn a corner in mid 24. And I think moving forward, we're not overbuilding. We're absorbing some of that space. The economy is doing okay. Leasing's going to happen. So some of these things that everybody's afraid, we're going to have ghost malls and ghost cities and ghost this, that, and the other. I mean, that wasn't the case even back in Halloween. I sure don't think it's going to be the case in 2025. So reasons to think even in some of those beaten down sectors like REITs and so on, you can probably pick and choose and find some attractive candidates.
Now, one theme that was carried over from, I think, 2023 into 2024 was also those regional banks. Since you brought up financials, are there any risks with the regional banks in your eyes?
Look, are there going to be, banks that fail? Are there going to be some more of that, some of those banks are going to run into trouble? Yeah, there are. At the end of the year, obviously, we don't know exactly what the final numbers will be, but at the end of the year, the S&P Regional Banking ETF, the KRE, was up about 17% heading into Christmas week. Now, would that be up 17% if every building was going to get sold for 50% off and every bank was insolvent and every, commercial real estate mortgage was going bad? No, it wouldn't be. The market's telling you, again, and it's not just the market, it's survey data that, buyers are starting to step up. They're willing to buy properties at discounts. Banks are moving some of this stuff slowly but surely off their balance sheets. Funds are, the vulture funds are active. That all is going on. So, I don't think that's going to be a big story. And to be honest, it's with the exception of some places in the media, it hasn't been a story from the stock performance, and it certainly hasn't been a story from the Fed's own data, which showed the last couple of quarters of 2024, all the tightening of credit standards in commercial real estate lending was actually reversing. More banks were starting to ease standards. So, it's a narrative that outlived its usefulness in 2024 based on how the market performed. And it's a narrative that's completely outlived its usefulness in terms of the underlying economy moving forward into 25.
So regarding the US dollar, that was also being watched very closely, especially over summer, that July, August, September time frame when the dollar went from right around 106 the whole way down to under 100 on the dollar index and then quickly rebounded. Dollar hasn't really been under 100 except for a few trading days or weeks over the last couple years. You said that you do see the dollar coming off a little bit, but does that mean we go back under that 100 on the dollar index?
Going back under that 100 is probably a pretty big ask, I think. But at the same time, I think we're kind of in a broad trading range. We're probably going to be fluctuating in that 100 to 110 level. I would be extremely surprised if we took out that sort of 115 or just below 115 level we had in 2022 when the Fed was raising rates like mad and everybody's worried about inflation. I just don't think the things that drove that are going to be with us in this year, in the next year and a half. So I'm just not as concerned about that. I think that, again, even when it comes to the Trump worries or whatever you want to call it, Trump's going to drive the interest rates up and drive the dollar up and so on. It's just one of those things that I think is overdone. It's an over fear or a worry that just has too much traction relative to what I think is really going to happen. Even if inflation does pick up a little bit, we kind of bounce around this 2.5% to 3.5% range versus get to 2%. That sure as heck isn't 6%, 7%, 8%, and I don't think we're going back to that. So if we're not going back to that, why would we have the interest rates and the currency kind of move that we had when we did have those conditions? You know what I mean?
I totally get it. But Mike, one other thing that we always need to consider when we're talking dollar, also when we're talking rates too, is what's going on around the world. And quite frankly, the last Fed meeting, they even revised up their GDP forecast. They even lowered a little bit their unemployment data. Overall, the US is continuing to look like one of the stronger economies out there. Does that change in 2025?
Yeah, I think what that tells you is, we're not going back to 0% rates. We're not in the world of ZIRP anymore. We're not going back to, 0.5 or 1% inflation or anything like that. But I don't think, again, I don't think it's going to be this rampaging situation where the U.S. economy just grows like mad and the rest of the world just sits around, either in recession or, whatever you want to call it, malaise forever. So I think that, U.S. can do well, and I like some of the domestically focused sector stocks that some of the names and groups I already mentioned. But at the same time, do I think we're due for, again, this sort of rampaging dollar? I mean, we know what happened in 2022. It was just wrecking everything, right? I mean, yields up, stocks down, dollar soaring, gold actually being flatlining on the year was outperformance, which is kind of crazy to think about. I think that trend is over, and I'd be, again, I think it kind of moves off the front page as the big story. I think if there's anything you got to worry about is, again, if we get into the thing that sort of derails my general bullish thesis is if I'm wrong about the rotation, if I'm wrong about the broadening, if I'm wrong about, other stuff besides tech doing well. I mean, we saw it in December until Powell kind of, surprised us. What started to happen? You started to see some of that dot-com-y kind of thing. Tesla was up every day. Bitcoin was going up thousands of dollars every day. Junk fart coin, for crying out loud, the crypto was going up every day. I mean, it was stuff that was just, .com-ish type trading action. I think that's why the market got spanked so bad when Powell pivoted a little bit. As long as we don't see that kind of stuff going on in the new year and just sort of taking off, like we had, you go back to the first quarter of 2000, before everything fell off a cliff, it was like, January and February, that was where, some of this .com stuff was going up $300 a day in share price. I don't think that's going to happen, but that's the one thing that would worry me if sort of that excessive exuberance that we started to see in December really starts going, into the first quarter of 25. So that's what I'll keep an eye on. But again, I don't see that being the case. I think it's more kind of rational happiness versus irrational exuberance.
What about Bitcoin and the cryptocurrencies? We do bring them up fairly regularly now, but boy, oh boy, they're in the news a lot. And under this administration, getting a lot more positive headlines. but there's so much that drives, I think, that cryptocurrency story outside of, I guess, governments, maybe even putting it into some strategic reserve, which is kind of a wild notion. What do you see as driving the cryptocurrency space this year?
I've always said that I'm not an expert on crypto, but I know some people that are, and I follow it enough from like a 30,000 foot up type view. I mean, I do think that it's clearly gaining institutional acceptance. It's clearly becoming an asset class that slowly but surely, is going to have, if a person, investor X, allocates 10% of his money to gold previously, is he going to maybe put 8% in gold and 2% in Bitcoin? Probably. You're going to see more of that kind of stuff going on, especially in the institutional world. But I think that it's one of those things. It's matured enough and it's had its big boom and bust that I understand why that's happening. I still happen to favor precious metals, and I think clearly you're seeing central banks that have been favoring gold as an asset. I think if the central banks obviously are probably the most stodgy institutions on the planet. So if they're going to get involved in doing more in the crypto space, it's going to be at an extremely glacial pace. So 20 years from now, maybe they have 1% of their assets in Bitcoin, versus whatever now. So I think it's going to be one of those things that, yeah, it'll kind of happen. It'll be more like turning a battleship. And, as an individual investor, you can play in that arena and you can have some exposure. But I still generally think the metals are kind of, for that portion of your portfolio that you want to have true protection and wealth building and, debt and deficit protection and whatever you want to call it. I think, gold probably fills that role a lot better.
Okay, so that's more precious metals. What about the rest of the commodity sector, though? How does that fare if we're in this environment where it sounds like the economy could be doing okay, inflation relatively under control, but still on everyone's radar? Does copper, does energy, all these different types of commodities and materials, do they catch a bid?
Yeah, I mean, look, I think we've talked about this before. It's so much tied to emerging markets in China and so on, construction, the big boom that we had there, and what have you. I mean, I think that you're getting a lot of stimulus in that economy. They're doing a lot of things to sort of prop up parts of their economy that have had this bust, and that's likely going to be something that slowly but surely turns. So sure, I don't think I'm not worried about that part of the market just continuing to slump and underperform forever. I just, it's one of those things that I think China's just got to get itself fixed, and it's going to do it by a combination of stimulus and spending and just gradual reprocessing of all this overbuilt property, and frankly, demolishing some of it too. So I think that especially at these levels, you can probably get involved there, but I don't think, this is going to be one of those years where you're going to say, wow, I just made 300% on a, copper mining company because copper is booming to the moon like you had when China was spending like mad.
Yeah, fair enough. Well, I guess we do need to circle around to politics then. Trump's policies, we've talked about them on different segments late last year, but when more time frame wise do you think Trump needs to follow through with some of these policies to, I guess, give the market the bullishness, that overall narrative that it took away from that election? Does it have to happen right away when he's in office?
I think I forget which one of our speakers said it when I was talking to them at the last conference, but they sort of said, you tend to get not halo period, like a grace period, where I think probably for the first quarter of this year, they're going to be willing to say, all right, if not something doesn't happen by January 31st, it doesn't mean the market's going to crash. They're going to kind of let the political stuff happen, see if they've got some momentum. But if we get into the second quarter and especially the second half, and we haven't seen progress on taxes, we've seen over aggressive tariffs. We haven't seen more progress on inflation, things like that the incoming administration has said they're going to help solve. That's when you really have problems. So I think that is part of it. If I had to revise my earlier statement on what would make me less bullish, I would also say if we really haven't gotten progress by middle or back half of the second quarter, that's when markets are going to get less forgiving and start tapping their feet and probably start selling off. If we haven't seen progress on taxes, if we haven't seen progress on regulation and so on.
Interesting. All right. Well, Mike, before I get you out of here, just give us a quick update on the next Money Show. Where is it going to be and what are the key themes?
Yeah, I appreciate that. We're going to be meeting in Las Vegas, back at the Paris, February 17th to 19th. It's our new year 2025 New Opportunities Conference. It's in mid-February. It's early enough in the year that we're going to be bringing experts together that are really, not just experts on equities, but we're going to have people that speak on precious metals, real estate, other parts of the commodities market, even the junior miners and so on. We're going to cover a little bit of everything, including crypto there. So it's going to be a great event. Vegas is always fun. If I can find a spot at the tables, I might even play in our poker night. I didn't at the last one because we sold the darn thing out. So I don't know. So maybe I'll see if I work on my bluffing skills, but it's going to be fun. It's at the Paris. We'd love to see as many of your listeners there as possible. It should be a great time.
Excellent. Well, to find out even more about that show, click that link in the show notes on our website or on your podcast player. Mike, great having you on the show, everyone. Thanks for tuning in to the first weekend show of the new year. Undoubtedly going to be an interesting year, and let's see how well these markets do. The last 2 years have been historic in many ways, and who knows what this year is going to lead to, but we're going to be covering it on a daily basis and on a weekly basis on the weekend show. So Mike, everyone listening, thanks for tuning in. I hope you all have a great rest of your weekend.
Thank you. Have a good one.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.